Session really being discussed today. It's the US mortgage blind spot.
My name is Yuval, founder and CEO, and we found out a little $1 trillion blind spot in the US residential market. Basically, what we found out from 20 years of experience in the cross-border space is that non-resident investors are usually with high liquidity, low risk, and people that want to invest in other countries. Well, investing in other countries, no one in their right mind puts their first asset into a residential real estate in another place. This comes in within 20 years of experience in M&A, LBO, residential real estate that I've accumulated during my entire career. So as you can see, we were featured in a bunch of places and now also in the Financial Times. And we've done quite a few transactions to make this worthwhile for hopefully people during drinks to listen to. But we'll figure it out soon. We're just a drinks entertainment. So basically the story started, I was an immigrant in 9 countries. Started off with moving to Italy, then the Netherlands, then Finland. After that, China, Brazil, Thailand, and a bunch of other countries. The issue over there was that in all these countries, the banking and credit system is based for domestic people. Reason being is local banks are not evil, regulators are not evil. It's just that we don't fit the box. Not fitting the box means an opportunity. And if most of these countries that are large investor countries, there's at least 2% to 5% foreign investors, that kind of presents a multi-billion-dollar opportunity in each of these economies. So my story, pretty simple. Built my first company out of China, profitable M&A, and then go-to-market business. December 2019, the largest market in the world shuts down. And then I realized if it shuts down, there's no exports, no construction workers, no construction materials. I have to buy a bunch of real estate as long as interest stays low. So I go to China, trying to buy my first property. In China, to buy a property, you have to go through the local CIA to approve you as a good, worthy Caucasian man that is not Chinese, that is allowed to buy in our country. And just like marriage, you can only, at least in most countries, you can only choose one property. It's monogamy. So if it's not the right property, you have to divorce it and you have to go through the CIA again. And then why do you sell your property? Didn't you say you're going to commit to it? So it's quite a pain in the ass. Then during COVID, I was one of those only people that traveled around the world, peak of COVID, to look for real estate in a bunch of countries because there was a big arbitrage opportunity. 1, interests were for free, 0. And 2, people weren't buying. So the market was frozen. So all these people you see around here, they weren't lending. They weren't buying securities. They weren't originating. They weren't securitizing. It was a total chaos. So went back to my home country of Israel. The bank wouldn't touch me because my income wasn't for there. Tried to buy in Brazil in a place called Florianopolis. It's like the Miami of South Brazil. No bank accounts for foreigners. Foreign exchange spread 10%. Then I said, okay, let's try the largest real estate market, most global in the world, which was New York. We spoke to a large developer that the bank also called them on a margin call, and we bought 80 properties. It took us only 8 months to close. It was a disaster. So I said, okay, I think there's kind of an arbitrage in Greece, also 7 months. So it was a big pain in the ass. And during this quick lecture, and hopefully funny, the ones that are here will tell me, I'll share with you why. So the main conclusion that we reached out is that global capital is mobile. We move around the world, especially in the last 20 years, but capital underwriting and all these capital markets, including rating agencies, do not know how to rate these borrowers. The fun part is those borrowers are the strongest because usually they have money. They can afford to live in another country. They can afford to hold their home in their home country, plus invest in other assets. But when they move to the new country, no one is welcoming them. Or, hi, welcome to our country. Now you start again. And for me, buying that first journey, when I bought that property in New York with a loan from HSBC that, okay, no, but a funny joke we used to say, I was a customer of theirs for 10 years. It's a global bank, but it's still, they make things complicated. Not because they're bad, just because it's a global system and they're a big bank. So my KYC took ages. It took me about 3 months to open a US-based entity. A bank account was easy because I was banking with them. Mortgage took me only 8 months. My US visa expired during COVID. And I'm not sure if any of you experienced needing visas. No consulates in the world were open. But try to explain that to a behemoth bank and they say, we don't care if you don't have a visa, you're not allowed in. So after trying to explain to them that if I'm not allowed in to an investment property, it's safer to them because I want to occupy it and not convincing, we were able to close the deal. Took only 8 months of torture, flew to Thailand, 2 weeks quarantine, got my visa approved. Now, a funny slide I like to show most of my friends at the banking system that we already sell loans to and people from Apollo, BlackRock, or others. This is how we see ourselves. We're savvy, we're like investing, we're easy to work with, but this is how the compliance department sees us. And if you have any naughty ideas, that's not what you see. It's just sugar and monopoly money and BB guns. But this is how they look at us. This is how they underwrite us. And this is the risk rating. We're going to fall with the boat, drown with the boat, but this, we actually know that we don't. The interesting part is the US, if you look at the numbers and forget what I'm showing here on the slide, when the US market crashed in 2009, 10, 11, 12, the largest ever foreign investment came into the US, about $1 trillion. The reason being is if the US crashes, everything else crashes. And economies that denominate their currency and their interest is pegged based on US real estate, like Latin America, were crushed. So people were saying, I can buy a property in Florida for 20K, but the land is worth 50K. It's worth my time. I'll buy 100 of them. So even now at a time of stagnation, people are not selling homes because they're sitting on low mortgages, high interest rate to buy new homes, US market frozen. The foreign market has increased by about 33%, while there's no construction, no new inventory, and the US is shorter about 3 to 5 million units. It's pretty insane. And why is that? Regulation is favorable. We're here in Europe. I own a bunch of properties. You can't evict tenants. If you have the wrong tenant, you have to beg them to leave. You have to pay them to leave. But in most of the US states, you can evict them without issues. So it's easy to foreclose. So you look at a market which is multi-trillion dollars, easy to foreclose, high yields, 10, 8, 12%, that in other markets, including in Europe or major cities in the US, it's about 2 to 3%. So great opportunity. And then when you look at the market of those mid net worth to high net worth, I would call them as busy professionals, but on the personal investment side, lazy, upper middle class or wealthy, misanthropes that don't want to leave the office and they want everything easy, and they will pay for no one to bother them. Just like we pay today for Amazon, even if it's a little premium, or Waltz to get our food delivery, same thing with the investment platform. These are the clients. And when you look at the data, there's more than 20 million of them. Their net worth is anywhere between close to 1 million to 30 million. They're not yet single family office. And those people never go delinquent. Those people do not need foreclosures. Those people buy S&P 500s and bonds and crypto and a bunch of real estate in a bunch of countries. So it's a very interesting tier. It's just hard to penetrate. So why is there a cross-border capital so hard to underwrite? So we look at a few things in different markets that are kind of all the same. One, it's the legacy model. So in the US, you have the FICO. In different countries in Europe, you have similar things. In Canada, you have a similar system called, you have like a FICO or Equifax, but you can't translate Canadian credit score to America. Then it's US-centric, or, in Israel, Brazil, it's local market-centric. It's income-based, and it's a very archaic manual process. Um, but the reality of global investors is asset-backed wealth, multi-market exposure, cash heavy behavior. We go bullish on different things, different assets. And part of their global portfolio, this is just a fraction, maybe 5, 10, 15% of their other assets. And when the S&P goes down, boom, let's buy more. When the USD goes down, great. My New York apartment last year was 40% more expensive. Let's buy two and leverage it. This is the behavior. This is how they work in different capital markets, and they're very savvy. And they usually have their white glove partners, realtors, mortgage brokers, wealth managers, and friends that are in all these countries because they went to global universities and they have exposures, or they go to one of these conferences over here. So the big question we ask is, why are we applying consumer credit logic to global capital? And let's look at what actually the data shows. So if you look at the US market, and that's a very conservative look, in the overall US mortgage delinquency, it's 3 to 5%. But the crisis happened when we had about 8, and that was subprime loans. But if you look at all that QM and non-QM and the 3 to 5 mortgage, when you look at the mortgages that we do to all these borrowers, and we processed about $1 billion in loans, we had 0 delinquencies, 0 foreclosures, and clients that do not want to be late on payments. So they'll be like, I'll put 50 months of reserves because I don't want to deal with it, and I don't want to be late, and I don't want to speak to a servicer. What is a servicer? Why do they call me? I don't want to talk to people. Just do it automatically. So when you look at the data, and it's no matter where they're from, the mix could be Latin America, countries in Europe, like UK buyers are back on buying because the pound was crushed and now it's 1.4, 1.3.5 to $1. So they're buying again. And every time you see a market fluctuation, example, when Lula was back from prison in Brazil, all the upper middle class was buying again in Orlando. When an extreme government in Colombia, same thing. And every time there's a market that fluctuates, these are the people that get their money out, and they know how to. So the model fails good borrowers because it relies on the wrong inputs. Mostly relies again on the FICO and US income. Global assets are invisible. We don't count them at all. Cross-border identity is hard to verify. Even though we have technology and companies like Entrust or Onfido that can identify people, and there's an uncertainty gets priced at risk. And I think the hardest part is also at foreclosure. People are really afraid, or banks or institutions are really afraid to foreclose on a borrower that lives abroad because Swiss lawyers are very expensive. But who cares? Your asset is at a low leverage in the US. And many of the big asset managers already manage large foreclosure companies because they love managing real estate, and they have also property management companies. So it's not an issue anymore. But this is how it is still. Now with fintech, the model is finally catching up to the borrower. Of course, with help of the regulator or no scrutiny of the regulator until you're big enough, and then they'll scrutinize you too. So today we can do cross-border identity verification, asset-backed underwriting. We're all at a very sophisticated conference, but when you look at the formula of lending, and if some of you watch The Big Short, it's pretty simple. The numerator is rent income, and the denominator is the expense of the property. If that is above 1, 70% leverage. Very simple. It's nothing more complicated. And if the borrower can afford to put the 30% down and the property pays for itself, amazing. Why would they give away 30% of $1 million property? Would you lose $300K on down payment on a property in New York or Florida? It doesn't make sense. So that's how it is. So what is it exactly that we touch here? So global investors are underserved and mispriced. What is the backbone here? It's right now, this is an amazing asset because it's risk high, but the rate of default is low. So there's a big arbitrage. You can price the loan at a high yield, because they have no choice, but give them good service and they don't care. And you don't need to foreclose, but the risk rating is still high because the rating agencies don't have enough data how to price them. The model now is fixed, and we think about the underwriting mechanism. We embrace the cross-border demand and build infrastructure for global capital. So we built it in our platform at Waltz. We're not promoting the company here. It's just about how people transact, and you can see people here from all over the world. And this is how we build it. We build a consolidated solution for the lazy, wealthy individuals that want to invest in US real estate, banking, insurance, wires, cross-border, foreign exchange, lending, and we sell the loans to many of the partners we see here in the room that love it because of the yield and gap. Spoken today to one of the banks that also want to expand. The main issue, so it's a great opportunity. We would love to expand. The best way for, we say it's called it a startup, even stable as or not, is defocus. And the US market is a tiny market of $50 trillion. And we really want to be a market leader that has 0.01 of the market. After that, we would like to expand to other geographies that the rental protection is not as favorable as the lender or the owner that actually takes the risk. So we would need to choose a geography that is lender friendly and owner friendly in case the people that take the loan or their tenants refuse to pay, and us as a lender or the bank that helps are suffering because we can't collect on a financial transaction that a mature adult signed off for and is violating. All right. Thanks for everyone.